Anish Tawakley joins us, Deputy CIO Equity with ICICI Prudential AMC. Anish, good morning. Thank you for joining us. What would you make of the current construct of the market based on valuations, behavior, and liquidity? How would you map that for us?
So I'd focus firstly on valuations and more importantly on earnings growth outlook. So valuations, at least in the large cap, are broadly in the reasonable zone. One could argue they are slightly expensive, but broadly they're in the reasonable zone. And therefore, from here, like what matters is earnings growth. And earnings growth obviously then depends on the economic outlook. And our view is that, like at least for the next two to 3 years, right, we look like cyclically we are well positioned, and the domestic cyclical sectors should do well. Frankly, flows are always unpredictable, and one can spend a lot of time discussing them. But my focus is more on valuations and earnings.
Valuations are above historical averages. And when valuations are above historical averages, future returns are compromised. Is that a very simple way of looking at markets?
So it depends on how much above averages, right? If they're like our equity valuation indices, right, we have this coding of green, red, and neutral, which is yellow. Obviously, if they're far above historical levels, right, then you don't make returns, even if the economy does well. But we're not that far above historical averages, right? So our view is that if earnings growth comes through, which, as I said, depends on the economic picture, then valuations, even if valuations moderate a bit, right, your returns should be reasonably healthy.
HDFC Bank numbers, not to discuss a stock, but to discuss a macro indicator. It is India's biggest bank, fourth largest in the world. They are suffering because liabilities are not getting created. As a result, they will have to slow down. So if HDFC Bank, which is the best brand, is struggling to get deposits and they have to slow down growth, others will have to do so. If that is the situation and banks don't lend, don't you think a slowdown is inevitable?
No. I wouldn't look at it that way at all. See, there are three, basically, if you look at the overall economy, right, there are three sources of financial intermediation. There is capital markets, which is, I'm saying, asset managers like us. There are insurance companies and there are banks, right? And ultimately, it's the household sector which chooses which intermediary they want to. Now, if it so happens that the household sector is choosing to park its funds in insurance through insurance products or through asset managers, you can have a healthy economic outlook because financial intermediation is still happening. Savings are still being given to investors, while bank deposit growth remains moderate. So one should not assume that bank deposit growth is essential or very robust bank deposit growth is essential for economic growth. If intermediation is happening through other channels, that is still pretty good. And that's what we are seeing, right? Where we are seeing that people are allocating more money to asset managers, and insurance flows are also reasonably heavy. So one should not draw that conclusion. Secondly, of course, I don't want to comment on single banks, but we should evaluate whether the banks' numbers were not healthy or whether expectations were unreasonably high. So let's wait for other deposit growth. Overall in the system looks reasonably, I mean, it's slightly on the lower side, but it's certainly not at worryingly low levels.
So, Anish, you were talking about the domestic cyclicals is, of course, one pocket where you do find comfort right now. Where else do you find valuation comfort in the market? And I want to just, point a direction to the most popular trade of last year, that's PSUs. Again, it's a very large umbrella there, but the most popular ones were your defense, railway, power financiers. Do you think one's got to be a little cautious here? Or do you still think there is both growth as well as value on the table?
No, I think the easy money in the PSU space has been made. From here, one has to be more discerning. It's not that straightforward that one can keep parking money in that space and getting rich. But in terms of so domestic cyclicals is our preferred area, as I mentioned, right? So that includes automobiles, cement, capital goods and industrial goods, and also non-bank financial intermediate like insurance companies and asset managers.
But where within autos, again, is your bias towards? Because what we're seeing is a sudden re-emergence of two-wheelers. The passenger vehicles, of course, had their time in the sun all through last year. But the slowdown is quite evident in the tractor numbers. And again, there's a different sect with CVs. Is it a blanket buy call when it comes to autos?
Also, tractors is cyclical, and that cycle doesn't necessarily follow the economic cycle. It's not necessarily consistent because it's not linked to industrial output. And tractors have been healthy for the last few years, so it's not surprising that tractors can slow down while the rest of the economy is still doing well. So I wouldn't say tractors, but yes, I think yes, passenger vehicles should recover. I don't think we will have a strong economy and weak passenger vehicle sales for a very long time, because passenger vehicles is linked to the economy, and I do think two-wheelers should continue to do.
Morning, Anish. We have to a certain extent seen these very exaggerated reactions coming in on individual stocks, be it the likes of an HDFC Bank or Polycab, just purely for example purpose. I just want to understand, do you think that these sort of reactions have been merited, that the stocks have been meted out with by the markets, given that we did not see this sort of a move, say, in the last couple of months for the market?
See, some of these reactions are driven, one by expectations and second by ownership. If stocks are very, very well owned broadly by a lot of people, then the reaction tends to be exaggerated. So one shouldn't read too much into individual stock reactions on results.
I'd like to draw your attention to the fallout of IT. Job hiring is slowing down. Impact on fresh campus recruits is also slowing down. AI will ensure that less job creation happens. What kind of impact this slowdown in IT hiring could have on this entire so-called IT ecosystem? Property prices in Bangalore, property prices in Chennai, luxury cars. What happens because of this?
So look, over the longer term, IT will have an impact. But the near term, right, I think what we are seeing is not necessarily the impact of IT, but two other things. One was that the expectations had gone up too high because even amongst industry participants, right, because during COVID, we had very strong growth. And to some extent, people had overhired, and we are just seeing a normalization from those overheated expectations. The second is that if we look at the economic impact, right, broader economic impact, we have to look not just at the Indian listed vendors, but also at the GCC space, right, the captives that all the overseas businesses now run in India. And actually, there has been some migration in activity from Indian vendors to captives, right? I was looking at some of the numbers. There are now apparently 1,600 captives in India, and the total workforce there is about 1.5 million. So from an overall economic perspective, we might not be seeing as the softness that we see in the Indian vendor space is not necessarily true of the overall space. So I wouldn't read that into negative economic impact for the rest of the sectors, right? The Indian vendors have to contend with the challenge of captives taking share and demand moderating to more reasonable levels from the froth and overheating that we had seen during COVID.
So, Anish, what are your bullish calls right now in the market? Because just about everyone is tilted towards A, of course, financials, banks mainly within that, and B, the emergence of EMS, renewables, the new energy sector, if I can call it that, is being looked at as the next breakthrough.
So our portfolios are public, and you'll see we were one of the most underweight portfolios on domestic banks. We have a bigger skew in financials towards asset managers and insurance companies, but we were significantly underweight banks. Second, other than that, we are, at least my portfolios are skewed towards automobiles, industrial and capital goods, and cement, because I do think the domestic recovery is looking good, and that outlook hasn't changed.
What is the right way of looking at industrials? I mean, I understand that there is a multi-year cycle, but if I look at some of the real good niche industrials, Thermax, Siemens, ABB, the valuations are pretty much trading at consumer companies now. So they are commanding ratios which essentially consumer companies have commanded in the past.
See, the fact is consumer companies are staples, so they remain steady, uh, irrespective of where the economic cycle is. But here you see a stronger cyclical uptick in earnings, right? So when your economic outlook, at least for a 2-year or a 3-year period, is strong, it's reasonable to assume that their valuations will be elevated. Second, I think we over focus on price to earnings ratios. We also have to look at the profitability and consequently the dividend yield that you get. Right? So some of these companies, while the PE ratio looks high, the ROEs are so strong that they pay very healthy dividends. And if you compare the dividend yields with the rest of the market, the gap is, I'm not saying they're cheap, but the gap is less outrageous.
Wanted to also just understand your outlook then in specific to what you're witnessing within the entire mid and the small cap space, given the kind of momentum that we witnessed last year, the kind of euphoria as well that we've seen. Do you think that maybe there's a chance that the sector got overvalued, and what's the play out for the rest of this year?
So mid and small caps, we are clearly cautious and we are concerned about valuations. So valuations in large caps are reasonable, provided earnings growth comes through, but mid and small cap is very, very, very rich.
Okay, very cautious there. Good to have you on board. Thank you so much for giving us your take as to how you're navigating the markets as well as your forward-looking statements. That's a view coming in.